You everyone for joining today. I'm looking forward to sharing some information with you about raising capital, a topic that's near and dear to the hearts of everybody that's forming a startup. Everyone knows that capital is an input, just like technology and energy and staffing. Capital is a very important input to grow a business, and there's a process and some tools that you need to successfully do that, and we're going to review them today, and I welcome your questions as we move through. You don't have to wait till the end. Okay, first slide. Thank you. So when you begin a startup, you're going to need to understand the size of your market. So what problem are you solving, and how big is the market for your product? In other words, how many people have your problem? How much are they willing to spend? How much money are they willing to give you for the solution that you've come up with? And in order to do this, you need to understand this, you need market research. You need to be able to verify data on the size of the market so that we don't guess. We use verifiable data. I know you know that, but it bears repeating. And we do customer discovery to confirm the need and viability of the business idea. So we don't just think, well, people would love for us to solve the problem this way. You actually talk to people that are in your target market, target audience for your product, and you talk to them about how big of a problem it is for them, and would your solution be a great way to solve the problem, and how much would they be willing to pay for it, and would they pay repeatedly over time? So there's a Carnegie Mellon Schwartz Center. There's the Project Olympus folks that do a wonderful job with customer discovery. And I encourage anybody that's starting out to work with them to learn the best practices for customer discovery. Okay, next slide. So it's really a good idea to remember that several minds is better than one. So it's a really good idea, a very good idea to have a team around you, not try to do this alone. It's very challenging to do everything that you need to do to lift a startup and to do it alone. It's much better to have fellow travelers on this startup journey, both co-founders that have different skills than you, and then also experienced mentors and advisors who have already had their own startups, already done the things that you're trying to do so that you can benefit from their knowledge. It's a really good idea. And we're lucky in this ecosystem at the Schwartz Center that there's a lot of other folks looking to work as co-founders and work as advisors. There's a network of advisors available to everyone. You can find them on the Schwartz Center's website. I'm one of them, so feel free to reach out to them with questions as well. Next slide. Okay, a business plan. This is a written document. It has a specific format. I am sure that you can get one from Allison or other folks at the Schwartz Center, the format for it. It describes exactly what your business is, what the features, benefits are, how it's organized, what your business model entails, and it talks about how your business will make money. It's a fairly extensive document. When it's finished, it will be several pages long. It's got a specific number of headings, but it's a wonderful way to organize your thoughts about your business and put your business into a document that other people recognize, investors, lenders, co-founders, people that you want to engage in your company. It's a very organized way to write down the sort of a executive summary of your business. There's detail in it, but it's enough that in a few pages, somebody who doesn't know what your business is would come to understand it. And it gives you the discipline of answering all the questions in a business plan. For example, what is your marketing plan? What is your staffing model? How much revenue do you think you'll raise? What is your pricing? It's got all of those things, and it's a document where you record those, and then share it with other people, mentors that can help you improve it. It's one way. It's a great tool as a startup to fine tune your business idea. Okay, next slide. All right. In order to raise capital, debt or equity, you need to demonstrate to investors that you have mathematically modeled your business. So what revenue do you expect? When do you expect it? What costs will you incur to create that revenue? The difference between the revenue and the cost is going to be your cost of goods sold is going to be your gross margin. The difference between revenue and all of your costs is going to be net margin. How much will you grow over time, by month and by year? What growth rate will that be? Burn rate. Burn rate is a word that you'll hear quite a bit. And what it is it's the amount of cash that you will spend each month as you're building your business. So it is very normal that you spend money before you make money. But you need to be able to tell investors how much money do you need to spend to build your business, and how much collectively will you spend until you become a profitable business, until you break even. You can't know the answers to any of those questions until you create a financial projection, both an income statement and a balance sheet, and it will tell you how much total capital you'll need to raise to become a profitable enterprise. A lot of times, investors and will ask you, how much money do you need? How much are you raising? And a lot of times, early startups aren't familiar with this question. And so I've had people say, well, someone told me I should never ask for less than $500,000, but they don't have a reason for it. Learning how much money you need for your startup cannot be done until you've done a pro forma, a financial projection, looking forward to say, I'm going to bring in this much revenue, but I'm not going to bring it in until I work for 6 months. And in that 6 months, I need to have money for data storage, or for salaries, or for electricity, or whatever your bills are going to be. I'm going to incur expense for 6 months before I get my first revenue. It's going to be another 12 months after I begin to have revenue before my revenue exceeds my costs and I'm profitable. So in aggregate, how much cash are you going to need to get to profitability? That's how much you need to raise. So it's very important to put this together before you approach anyone for capital. And I'm welcome, again, anybody that has a question, feel free to ask. Okay, next slide. All right. So you need to understand who your potential customers are, and not just in broad strokes, not just adults ages 18 to 35 or adults that ride bicycles or something. You need a really a very detailed description of your potential customer. Not only what age are they, where do they live, how much education do they have, how often would they use your product? Is there, can you describe them with an income, with a lifestyle, with even a name, the things that they do in their life? You want to describe that potential customer in detail as much as you can. And then you want to find at least 100 of those potential customers and talk to them about your startup. And again, this is part of the customer discovery. Find the ones that are going to use your product. And then once people have engaged with your initial release or your initial product, get testimonials from them. What did you like about it? What did you not like about it? What would you change? Very, very important to bridge the gap between what you imagine, how you imagine someone will use something, and how they actually use it, how you expect them to engage, and how they actually engage. It's very, very helpful. And writing down as much detail about those experiences as possible is important. Okay, next. All right. Real ability. It's a very good idea to begin um, when you think of an idea for a startup. Make sure that your idea is connects in some way to your own or your co-founders' experiences in life. So you, for example, I helped a startup where the founder was creating a um, a dial, an on-off switch for a stove. That she was an engineer, very interested in creating a stove um, dial, a control for a residential stove, because her grandmother had started a fire by leaving the house whenever her stove was still on. She was creating a way to turn off your stove remotely using technology. She's actually been very successful. Um, so it was her personal experience. Not only was she an engineer, a mechanical engineer, but she also had a personal investment in solving that problem because it had harmed someone close to her. So it's a very good idea that if you're going to start something, that you have real ability in the disciplines necessary to make that um, startup successful, or you have a co-founder who does. And that if that your education, your life experience makes sense with the business model, and that you reach out to you get outside training and other resources to fill in any gaps that you have in your real ability and that of your teams. So in general, we don't start a business with something we're not familiar with. We want to keep the idea aligned with our skills, our interests, our passions, and our experience. Next slide. Okay, a brand. This is really important. Brands help to communicate your business in a visual way. And also, your brand encompasses not just a logo, for example, or the name of your company, but also your reputation for excellence at what you do, your where you fit in the market. Are you a product for which quadrant of the market are you a product for? Who is your customer? The brand is going to align with that. So, for example, if your brand, you're creating a brand for Dior or Mercedes-Benz, your brand impression is going to be one of excellence and luxury and high quality. If you're creating a product for, I don't know, a brand for fast food, maybe your brand is going to be much more kind of accessible and friendly and moderately priced. So you're going to communicate a great deal with your brand, and you want to think very hard about that. And things like your name, the colors you choose, the logo you choose, the way you advertise, the way you market, the channels you choose. Those are all ways to convey the overall identity of your business. And it's something to take very seriously and get good qualified advisors to help evaluate the brand that you put forward.
Okay.
Yes.
One question. What do you think of examples such as DoorDash, where the founders, instead of having an idea already in their minds, they interviewed a bunch of local shops, for example, San Francisco, and found out that delivery was one of the main problems?
I agree. Again, that's customer discovery. I worked with a firm maybe 5 years ago, a McGinnis Ventures winner, They took second place in the McGinnis Ventures competition. And what happened with them was they came to me and said, we have a business, an app that we want to use to help women just like me lose 5 pounds or lose 10 pounds, lose a little bit of weight. And I looked at it and I said, oh, that was curious. It was gamified. It was really, really a great app. But when we looked at the competition, it turned out that there were a lot of competitors also trying to help women like me lose 5 to 10 pounds. There was a very, very crowded space. And in their customer discovery, they started interviewing women like me about their app. And what they kept hearing was, it's really interesting, it's really nice, but it seems like it's for kids. So they pivoted to create an app for children and found out that there was a huge, huge need for a tool that would help parents encourage their children to eat more healthfully to reduce obesity and childhood diabetes. And that right down the street at Pitt, there was a Center for Childhood Obesity, and the executive director became their advisor. And so, yes, absolutely, that's a great way. You can find out what problems exist to be solved. You don't have to start from your own brain. You can always pull in other outside resources. So sure.
Thank you.
Does that answer your question?
Yeah, it does. I guess maybe you can have a passion or a cause that can potentially be, for example, maybe you want to help local shops in San Francisco. What you do is you interview them, and through that you can build a product that helps them. So I guess you can build upon your passions by interviewing people.
You can go out and seek a problem to solve, sure. And you may find that when you interview a whole bunch of your potential customers that they have a common problem. And if you don't, then you can pivot to another direction. So yes. Anybody else? Okay, next slide. All right, so here again, the ask. You have to have, when you're trying to raise money, you have to know how much money you're raising, and not only how much you need, when do you need it, and if you get it, if someone were to hand you $500,000 today or $1 million tomorrow, what would you use it for, and what milestones would you achieve with the money, and when? So it's not just, I need some money, will you invest in me? It's really, I have a burn rate of $10,000 a month. I need 6 months to begin earning revenue. I need 12 months to become profitable. So I need to raise $180,000 at a minimum. Or, that's just kind of a very, very quick example. But again, as I mentioned before, you have to mathematically model your business, figure out what it's going to cost you to build, how long it will take, and then match the incoming funds with your need. But you have to also make very clear, if you give me 100,000, I will use it to get to this milestone. If I raise $500,000, that will be enough capital that I will have 18 to 24 months of runway, meaning I have enough money to cover my burn rate for 18 to 24 months so that I can work on my business and not spend every day raising money. One of the really big issues is that it takes a lot of time to raise money. And if the founders are spending all their time raising money, they don't have the time to work on the business and hit the milestones they've committed to. And so that kind of ability to know how much you need to get to profitability and to give yourself at least 18 to 24 months runway so you don't have to continually raise money is very important. Any questions? Okay, next slide. All right, so when investors invest in a company, They are not doing it because of altruism. They are doing it because they believe that if they invest the funds in your startup, they will make more money quicker than if they invest in someone else's startup. So it's very important when you ask for investment that you understand how investors will get their money back. Are you going to exit in 3 to 5 years, or do you want to continue to run the business? Do you want to repay your investors with a, based on their equity in your business because you've exited, or do you want to raise capital and buy them out, which can be done? But you need to know up front what your exit plan is, how long until you get there, and how much will they earn. So if you're saying, give me your $1 million or give me your $200,000, and I will return it to you in 3 years with a 200% investment return, they can then compare that proposal to what another startup is asking. But you have to address this issue. You have to say, I plan to exit and I will exit through acquisition. And these are some of the potential acquirers. And those acquirers have made other acquisitions in the last 18 months. And they paid this kind of multiple of revenue or EBITDA for the company. And so I am basing my estimated return on those prior experiences. Now, crowdfunding is another source of capital that can be used. And in order to crowdsource, you have to specify a return or a reward for people that make different levels of investment. And you have to understand those before you set up before you engage with a crowdfunding platform. Okay. Next slide.
Can you hear me okay?
No, I can. Go ahead.
I just had a question about if you're so as you're doing these pitches, the investors are investing in essentially you more than the company, usually at the earliest stage. And I'm just curious how, when you say to an investor, oh, I plan to exit within 3 years or acquisition or what have you, how investors respond to that if they want that business to grow. If their thought process is, we want this to grow much bigger than you as a person expect it to. Like I would assume VCs are looking for unicorn businesses. But is that basically the expectation that I will stay with this business until it gets to the maximum size that you're looking for?
I understand. That's a good question. No. So I have another talk on the CMU Connects channel, and it talks about the different levels of investment and the timing of them. So there are phases of investment. You begin your startup journey with what's called friends and family money, people that just invest in you because they know you, love you, trust you, and whatever you do, they're going to give you money. So that's your first round of investment, and that's usually a maximum of a couple of $100,000, although it can be more depending on who your friends and family are. After that, the next round of funding comes from angel investors who invest for anywhere from a few $1,000s, $10,000 up to $1 million, maybe even $1.5 million before you get to VCs. So in your description of your question, you mentioned VCs right away, and that's not where you go first. So I wanted to make sure that that's clear.
Okay.
And so what you're talking about early stage when you're a startup is getting funding from angel investors first before VCs, and then that would be local VCs and then, more national ones. Are they looking for unicorns? I guess you could say everyone is, but there's so many businesses that make a lot of money. They sell for 100 million or 400 million, or, before we talk about billions. There's certainly a lot to be gained for an investor from exiting at 200 million, and because there's lots of investments where they take a risk and don't make anything. So is everybody looking for a unicorn? No. Do they expect you to stay until you have a unicorn? No, but they do expect you to stay long enough to build your corporate valuation to a point where they're going to make a significant income. It's really important to understand one fundamental about investing. Risk and return are aligned. So when you take a certain amount of risk, you need to get a certain amount of return. And angel investing in venture capital is a very risky part of an investment portfolio. Someone might say the riskiest. And so they need to understand that the founder is aware that they need to have an exit at some point. And you could legitimately, and I have seen this happen, where you say, I don't really want to sell. I want to build this business and I want to keep it for 20 years. That's fine. You can do that. But then you have to make clear to the investors that I will raise capital to buy you out when I get to a certain level. I don't intend to exit. I don't want to be acquired. Because investors have a right to know that when they go in. They can accept that proposition or not. And also things change. So you could say, my pro forma says that I'm going to be profitable in year 3. I'm going to exit in year 5 if I can raise this much capital and keep to my schedule. And I'm going to exit, and there's 10 companies that could potentially acquire me. And the returns that I'm seeing in the market are like this. Everyone knows that we're talking about the future. Everything can change. But you are demonstrating that you understand that an investor is not there because they like you. They are there because they are trying to evaluate whether you can give them an investment return that is as good or better than the other investment options they have. Every investor is being asked by many companies to invest, and they have to be able to compare them. And that's one of the very big ways that they do it. Does that answer your question?
Yeah, thank you.
Uh-huh. Anybody else? Okay, you need a pitch deck. I know everybody knows this, but let's talk a little bit more granularly about what a deck's got to be. So when you're in a pitch contest or when you're pitching to investors, you need to be able to explain the problem, explain your solution, explain the market, explain how much money you can make in your exit. All of that in under 15 slides. You need to be able to do that in a very pithy, organized, and impactful way. And it's very important that you be able to do that. Too much stuff on slides, too many slides, investors you're going to lose them. However, that does not mean that you don't have at your disposal when you pitch another 50 slides that get very granular with your business model, with your pro forma, with your idea, with your market data. You have all sorts of detail that you can pull up. If an investor asks you a specific question, you can say, oh, yes, we do have that information. Here's a slide. I have seen very great presentations given by, again, main slides, 12 to 15 slides at the beginning to make the initial pitch. And then when the investors have questions, they have access to another 50 slides and they can pull it up to respond to an investor question. Very effective. The teaser deck is it's a very tight, compact explanation of the problem you're solving, how you will solve it, the market potential, and information about you and your team that you can use just to make an investor interested in listening to your greater pitch. So this initial deck that I'm talking about is the pitch, the one you'd use, the 12 to 15 slides. The intro deck is less. The supplemental deck can be 50, 100 slides, whatever you want, with all sorts of detailed diagrams, flow charts, detailed numbers, everything that you would have at your disposal to use in a pitch to respond to an investor question, but you won't necessarily use them. You just have them to demonstrate the depth of your knowledge. Okay, next slide. Your investment summary. This is very important. So let's say that you have a great pitch deck, you have a great startup, you have a great idea, you've thought through your your go-to-market strategy, you have a great sense of, a deal of success. You've enticed some investors to be very interested in investing. And they say to you, okay, how are you taking in money? So you need to know on what vehicle are you going to take money in? Are you using a convertible note? Is it going to be a safe? What is the structure? Is there a discount? What is the implied valuation? These are all topics that you can get much more information about than I'm giving you here. There are full CMU Connects talks on specific of those topics. Valuations, what they are, how you determine them, who determines them, lead investors. There's lots of detail available. I'm not intending to cover all those topics right here, but it's very important that you think about, if someone wants to give me money today, how are they going to do it? And you put the structure of the investment on one single page. And that includes, I am raising a seed round. That seed round is $500,000. I'm going to use the $500,000 for this. I am taking the $500,000 in on a safe, and the safe has this structure, or on a convertible note with this valuation and this structure. And you have that written down and ready to go, and you have your legal documents in order to codify that investment structure, so that if someone says, I'm ready to invest, you are ready to take their money. Next slide, please. Okay, the term sheet. This is not mandatory, but it is a very good idea. Again, it's a one-page summary of the investment terms and conditions that we just talked about, but a little more detail. So, is there a minimum investment? How much is the round? What is the implied valuation? Pre-money, post-money. If you buy equity, how much do you have to invest to get voting rights? Who's on the board? What type of investment gets a seat on the board? For how long? Who can be seated on the board? It's a lot of the investment detail that, again, not mandatory, but if you've thought through these things, you will separate yourself from the crowd and demonstrate that you are very serious about taking an investment. Next slide. Okay, so again, we're talking about where to go when you're ready to raise money. Now that you've done all this hard work and you have this wonderful startup and you're ready to take in capital, who do you ask for capital? You begin with yourself. Everybody wants to know that as a founder, that you have invested your own time and money and that you have done all this preliminary work on your own dime, that you're invested in it. You don't expect anybody else to invest into something that you haven't made a significant investment in yourself. And then you go to friends and family. These are people with resources to help you, who are only willing to help because they know you and they trust you. And they believe that you will carry forward. Whatever you invest in, you are going to move forward and do what you say you're going to do. So that's the next round. Again, smaller amounts typically. And then seed funds, your seed round is going to be coming from angel investors, angel funds. An angel fund is where investors might collectively put in $5,000 or $10,000 each, and then they aggregate their funding into a trust, and that angel fund then makes an investment on your cap table as one line item instead of each investor having their own line item, and you keep your cap table fairly clean, which is a benefit when you're taking in larger investment. In high net worth individuals that are qualified investors can invest in you. And then there are venture capital funds that invest in early stage ventures. And then after that, when you need larger amounts of capital, when you're raising your Series A, you go to strategic investors and venture capitalists. One thing that's very important to remember when you're at the seed stage is that you need a lead investor. A lead investor is someone who is not only going to put in a significant amount of money in the round, but they are willing to come forward and establish the structure of the round. So they set the terms for the round that your other follow-on investors have to accept. So you want that person to be willing to do that, which is an investment of time and expertise. Everybody that is the angel investor is not willing to take a lead. Only about 25% of them are. So when you're talking to angel investors and you know you need a lead, make sure you begin the conversations with, make sure you do your research and figure out if the angel investors you're speaking with are willing to take a lead. That's who you want to talk to first, because they're going to have to establish the structure before anybody else can invest. So that's one thing I would like to make sure I say before we exit here. Any questions about this? Okay, next slide. Okay, very important. The investor fit. All investors are not the same. They're not all equally interested in the problem you're solving. So again, you want to find out if this investor is interested in early stage or if they really want to wait until you are have more traction. Traction is a word you'll hear. What does traction mean? It means that you have paying customers. It means that you have a product that's ready to go to market, that you have proven your thesis, that there really are people willing to give you money to buy what you've created. A lot of times, I'm an angel investor. I belong to an angel fund, and I will often hear people will present, and at the end, the evaluation will be, well, they're just too early. We'd like to talk to them again in a year. That means that people are presenting to this angel fund, this group of angel investors, without knowing what types of investments they're looking for. That's a bad fit and a waste of everybody's time, and nobody wants to do that. So understand that if you are looking for really early stage money, make sure the investors you're speaking with are interested in very early stage investments, higher risk. And then also the investor vertical. So there are funds that are just interested in SaaS models. That's all they look for. There are ones that focus on fintech, ones that like in manufacturing, consumer packaged goods. That's what CPG is. Renewable energy. There's a lot of verticals. So find investors that are really interested in the part of the market that your business would function in. Save yourself a lot of time and energy if you think hard about which investors, not just anybody that is an investor. Next slide. Okay, so how do you actually do this? How do you look for investors? So you make a list. You do your research, find out who invests and what do they invest in, what stage, what vertical, what are their backgrounds, what have they invested in before. And then you begin trying to get meetings with some of them. And if you're lucky enough to get those meetings, and you show them your preliminary pitch and they say, if they say yes, God bless you. If they say no, find out why. What is it that they thought they were looking for that you didn't have? That will help you to strengthen your pitch for the next investor. Investing and raising funds is very much iterative. And when there's so much to know about it, that when you are doing it for the first time, it would be impossible to be really good at it right away. So we, just like when you learn anything, you learn through repetition and from learning from experience. So make sure if someone says no, you don't leave without understanding why. Next slide. Okay, so here we are. This is our checklist. So these are the things needed to know that you're ready to take an investment. So we've covered all of these, and I'm happy to share the slides, or Allison will, with anyone that would like them. And I I welcome your questions. And I'd like to hear about what startups what you're starting up and where you are in your journey.
Yeah, I had a question. What are the benefits and maybe the cons of having a lead investor?
Well, you have to have a lead investor. If you are simply taking in money, for example, on a SAFE, a simple agreement for equity, which does not require a valuation, and it's just it's terms that you would set with your initial counsel and your board, to say we're taking in money at a certain discount, and the equity price is this. And if the equity price is 50 cents and you give us $1, we'll give you two units. The structure will depend on your corporate formation too. Are you a Delaware C or are you a LLC? There's different. You don't have shares unless you're a C. You have membership units if you're an LLC. But anyway, your attorneys will explain all of that. But when you get past the point where you want to have a priced round, a structured priced round, so some people that's the seed, some it's the Series A, you have to have a lead investor. Someone has to be willing to come forward and say, I will put in the first money. I will put in a significant amount, maybe $250,000, $500,000, maybe more. But I will do that while setting the terms of the round, and the other investors will comply with those terms. You cannot you have to have somebody willing to make the first significant investment, and they have to agree to the terms. And the most efficient way to do that is to have them work on the terms before they're set, or set them. Does that make sense?
Yeah. Couldn't the founder do that? Or it's usually the investors who decide? Right.
If the founder can put in their own first million.
No. Like, why does the lead investor have to, set the price, and why wouldn't the founder do that?
Because the founder needs the investment, and it is much better to go to investors and say, I would like to interest you in investing in my company. I would like you to make a significant commitment to my company, and I would like you to do that. And in order to make that possible, I am willing to allow you to set the terms. Other investors are not going to come along and say, oh, the founder said they want this for these terms and we'll go for it. Unless you've had 3 startups already, you've sold 3, you've made a ton of money for your investors on all 3. And the new one, you might say, I want the same terms as my last startup. That's possible. But in general, when you're a new founder and you have not had that kind of experience, you want a sophisticated investor to set your terms so that other investors have trust.
Makes sense.
Anybody else? Or another question? Anybody want to talk about their startup? Are there particular challenges?
I had a question. If you're part of an incubator, how much of the work in this checklist can you expect them to do for you or assist you with doing?
That's a great question. That is a really great question. Thank you for asking it. No incubator is going to do all this. I've not seen one yet that does. A lot of times, and they will tell you up front, what they're going to focus on, usually. And they may say, we understand that you need all of this. We're going to focus in the next however many weeks or months you have with them. They're going to focus on one particular part of this list. But I have not yet seen one that does it all. So I could be wrong, but I have seen many of them. I have experience with many of them, and they do quite a bit. But it depends on the phase. So a lot of times incubators are for really early stage companies. And so what they really want to do is help you focus on the product market fit, the customer discovery, the minimum viable product, getting to a point where you are ready to market a service or product. But the disciplines involved in beginning a business, marketing, sales, finance, human resource, there's so much to it. That's not all going to get covered ever. But that doesn't mean that they're not valuable, that you won't make great connections, that you won't meet other people that are also starting companies, and that you won't get good, worthwhile guidance. But going in with the expectation that you're going to come out with a complete, with all of these accomplished is not realistic, in my experience.
Thank you.
Anybody want to talk about their startup or have any other questions? Okay, Allison, anything else?
We have one more question in person.
Super.
She's going to come up.
Good. That's even better. I was having trouble hearing the ones that were far away.
Hi, Christine. My name is Ashwini. I'm a first year MBA and I'm working on an electric vehicle charging solution company that's portable and comes to you. My question is, does any of this change when raising money involves a lot of capital and not having like an MVP because it takes money to have the first MVP? So like deep tech solutions.
That's a great question too. And a very logical one. And I am an electric car owner. So that's a terrific. I actually saw a pitch from a founder in California recently that talked about this particular problem at length. So it was really interesting, the timing of it. No, it's very normal to have an idea, especially if you're going to manufacture something where you need a prototype and you need capital for the prototype. It's very normal to need that capital to build that first. But you can still convince investors that you have identified a problem that needs to be solved. You have designed, even if you haven't built it yet, you have a product that is worth being built, a minimum viable product. You can identify the manufacturer that could build that prototype. You can get details on the parts that you'll need, the time it will take to build, how much the building will cost. You can get all of that information to demonstrate that you have very well thought out your product. And that when you go to an investor and say, I want the earliest stage investment, that like idea stage, they call it. And there are lots of investors that choose that. They want to be on the ground floor because remember, the earlier an investor invests, the more risk they take and the more money they make when you exit. So if you want to wait until someone has traction, if you want to wait until they've already proven their product, you can still make money, but you will certainly make less than the investor who comes in very early. So it's a trade-off. Take more risk, make more money. Some people are comfortable with that. Some people want to wait. Some people want a portfolio that includes both things. Some products where they invest early and some where they wait till later so that they balance their risk.